Hello, my name is Eddie Tofpik. I am Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans. Beans in the teens? No, but we are so close to being so, again. What had been threatened here for weeks, months even, and which finally came about back in mid-August, was moving below 13 even. And that move is still being mulled over. All attempts over the last 3 weeks to either drop below 1260 or over 1320 have failed. We've basically gone sideways during that time. Now, going back a bit, I said 7 weeks ago here how I'd noticed two possible patterns, new patterns, not necessarily complementary to each other. The first was a mid-June to mid-August ascending triangle. The flat topside trend line was capped by the resistance at 1459, whilst the broken, rising mid-June to date uptrend, currently at 1405, is the lower trend line. Now, I also speculated that the rising long moving average, currently 1387, may have been a dynamic contender for the same rising uptrend, or at least an influence. And now the declining medium moving average, currently 1393, may have been a dynamic contender for the flat topside trendline, or again, as an influencer. Anyway, by late August, the market broke down through both the long moving average and the lower trendline. It is at this point that I'd like to mention once more the second related pattern which I'd seen, and that's the bearish halfway hesitation. That takes the action from early to mid-June, making the left-hand flagpole. Now, the market has in reality made a bit of a mess of the right-hand side flagpole. In part, probably a large part actually, this has been due to the clash with the ascending triangle pattern. Nevertheless, prices had moved lower, down through the lows of June and back to late August, reaching the old target X again in the 1290 area. This was the original primary target for the ascending triangle. And this is where we've seemingly been held these past 3 weeks. So what's next? Well, it seemed reasonable to first look to the downside. So, below, we've had for a few weeks now two key potential targets. Target X1 is the secondary target for the ascending triangle in the 1202 area, and target X2, the first possible ragged bear flag target in the 1178 area. Now, the problem, apart from the lack of follow-through lower, or a rejection back up even, is what we have in between current levels and the two targets. We have two key 50% Fibonacci level supports below. One for the April 2020 to May 2021 move at 1243, and the other for the 2019 to May 2021 move at 1229. These 50% Fibonacci levels are quite new, only finalized back in May this year, but they are still there. Otherwise, there are seemingly limited supports available until the 1140s. As for the top side, well, the declining short-medium moving average, currently at 1335, is the first obvious choice. But I suspect the long moving average, currently 1387, especially as it reaches up towards the declining medium moving average, currently 1394, may be a better resistance. Okay. So I would normally leave it there, except I had back in early September a short and very interesting conversation with Andre Sheckman in Brazil, a very good friend of mine and also a technical analyst. He asked me to look at the whole of 2021 here as a possible head and shoulders top. And I have to say, what he asked does indeed have merit. Now, I will continue to ponder upon this further, as the action does not have as clear a neckline as I would like. But I can say this: the market was hesitating and is still hesitating right on the area a neckline would be drawn. So continuous caution is therefore advised here. Chicago soybean meal. I wrote some 11 weeks ago, and I quote, "The month of May was a monthly key reversal down. It is important to remember that." End of quote. What I wanted to emphasize at that time and since is that everything since May has been in the shadow of that singularly bearish pattern. With this in mind, it brings into perspective the breakdown in June, down through the long moving average currently at 393.80, and also a drop down to the lower time currently 296.20 of the bearish 2021 Andrews pitchfork. The subsequent bounce up only ended in the market going sideways throughout July and August, and also running along the underside of the middle time currently at 342.5. As part of this action, prices created a lower trend line currently 344.90, and thus drew a descending triangle pattern over July and August. In late August, prices punched down through the lower trend line of the descending triangle and finally reached target X in the 337.20 area. This was the original target for the bear flag seen during May and June. However, whilst 2 weeks ago prices still continued to inch lower, the market seemingly felt that it was also too far away from the comfort of the middle time overhead and spent last week moving back upwards, thus this week reaching the middle time once more. In all that time, we still have below an initial target X1 for the descending triangle in the 326.10 area, whilst the secondary target X2 would be in the 306.80 area. This is, of course, assumes the current move lower continues to be a genuine break lower. And to be honest, the last 3 weeks lower and sideways action does sow a very small seed of doubt. As a final point, I would like to once again recognize the wonderful job the bearish Andrews pitchfork for 2021, originally drawn back in May, has done in its overall task of channeling the market lower. It has been useful and valid up until this very day, and perhaps for some time forward. That is the key to the market here, the bearish Andrews pitchfork. When it gets busted or adjusted to a bearish shift pitchfork or some other pattern, then we can look for new ideas. But until then, the bearish incentive is still run and ruled in this market by this same bearish Andrews pitchfork. And just please remember that. Chicago soybean oil. For months now I have highlighted the rather lopsided diamond patterns seen over May to July. Looking again today, I still find it to be the key pattern here, but it has some other competing patterns now. A few words again first on the diamond pattern. Diamond patterns can be tops, bottoms or continuations. In this particular case it is a top. Back in late July the market broke down through the lower trend line but did not immediately follow through lower. Instead, the market chose to run along the underside of the broken trend line. Now this stopped when the market reached the right hand side apex of the diamond at the end of July. This provided also additional bearish pressure to the diamond pattern's breakdown, making it a genuine action. Anyway, prices dropped but then came across an obstacle. The medium moving average, currently at 61.99, and halted for a while in early August. However, by the middle of the month, prices had overcome the obstacle and continued their journey lower through the congestion zone between 57.64 and 59.44, which you can see as a striped band across the middle of the daily chart, and bunching through the lower trend line currently at 55.22 of the July to date descending wedge pattern, but not really exploiting the breach. This week prices tried again to move below the lower trend line, but they met another, in this case, pair of obstacles. They are the rising long moving average, currently at 55.09, and the 50% Fibonacci line for the whole of 2021 so far at 55.43. Now we have two consecutive prices below the 50% Fibonacci line, closes indeed below the 50% Fibonacci line, if only just on the second day. However, we did not have a close below the long moving average despite 2 days of breaching and trying. Interesting, this is the first time the market has dipped below the long moving average since July last year. Anyway, prices have since moved back up again within the descending wedge pattern and are currently holding just short of a small overhead late August based downtrend currently at 57.81. All this action has brought us closer to the two targets for the diamond pattern. The initial target X in the 55.90 area was achieved the week before last. Nice action by the market there, and we still have a secondary target X1 in the 53.80 area. The main obstacle, as I mentioned back in my last commentary, and I quote, is the gently rising long moving average below, end of quote. To be honest, achieving the primary target X on its own is a big win, and going the extra bit to reach target X1 would be nice, but not essential. What it may mean is, if we fail to do so, is that I will now have to try and see what the next major pattern will be. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.